Konnichiwa and Salam Alaikum. In the UAE markets this week, we've seen some more weakness flow through to local bourses, with the DFM now trading at 1570 and the ADX index on 2719. Credit conditions continue to tighten and the EBOR has increased to 2.2%, reflecting the reluctance of international creditors to expand their money supply to this region. Investors have also remained on the sidelines with these markets, awaiting further clarification on what the restructuring proposal will look like from Dubai World to its creditors locally and internationally. We were getting towards the end of the reporting season, and although there have been some standout strong results, overall companies for the full year and the fourth quarter of 2009 have reported earnings below expectations, with 12 out of the top 16 stocks delivering profits below what the consensus forecasts were for. In local corporate news this week, Dubai has also launched its new cruise ship terminal, which is expected to boost the number of tourists from anywhere between 50,000 to 100,000 annually over the next 1 to 2 years, and resulting in an extra 30 or 40 ships coming into Dubai. We expect that tourism will continue to underpin local GDP growth, and Dubai has a lot to offer on the tourist front, which flows through then to consumption, tourism services, and also building related activity, and increases local GDP and corporate earnings. Drake & Skull International has announced that it will invest 500 million dirhams on acquiring 3 new companies this year, one of them being in Saudi Arabia, the second one in Qatar, and then another third one also in Qatar, expected to be acquired by the end of the year. According to the UAE Central Bank, specific provisions for non-performing loans have risen by 64% over the last 12 months for UAE banks, taking the total provisioning to 45.8 billion dirhams against a total loan book of just over 1 trillion dirhams. This means that around 4.6% of all the loans in the UAE are classified as non-performing and have been written off and provided for. Banks have been consistently raising their provisioning ratios over 2009, and this is one of the major reasons why profits in the fourth quarter of 2009 were below expectations, because write-downs relating to the Saad and Al Ghasabi groups began to creep into bank profit and loss statements. Overall, we think that rising provisions is a good philosophy for local banks, given that it more accurately reflects the credit conditions that are currently facing banks with their exposures to corporations and also households in the UAE. According to a report by Moody's Investor Services, banks in the UAE have total exposure of $15 billion to Dubai World. The report also said that these top 12 rated UAE banks have the ability to absorb around 40% of write-downs of these loans and still retain liquidity, although profitability no doubt will suffer in the event that 40% of these loans have to be written off. In the investment banking space, Waha Capital has announced a 12.5% bonus share issue for shareholders, and also has flagged an intention to seek Sukuk funding worth 1 billion dirhams. In the trade space, Dubai's non-oil exports rose by 23% during 2009 to 52.4 billion dirhams. This was largely driven by rising numbers of transshipment and also re-exports to neighbouring countries in the MENA, Africa, and also India and Pakistan regions. The main export products continue to be precious metals and stones, followed by normal metal products, processed food, and then plastic and rubber products. In the property space, Abu Dhabi property developers expect 5,000 to 10,000 new housing units to be ready for delivery and occupancy during 2010. 90% of this is forecast to be in the medium to upscale apartment area. So rents, given this new supply, are expected to fall by between 5 and 10% over the course of the next 12 months, following on from 30 to 35% rent and price declines during 2009. Really what's the key here is the Abu Dhabi government pushing ahead with infrastructure projects to create new jobs for workers to fill this supply coming on stream, and make sure that rental and prices don't fall by too much and reduce property sector confidence during 2010. Saru Properties, listed on the ADX, plans to hand over 1,100 of these residential units during 2010, including units from the large Sun and Sky Tower developments. The handover of these units should show in the 2010 third quarter results, and the developer plans to increase its rental income based on these new projects to around 12% of total income by the end of the year. Saru reported FY09 net profit of 495 million dirhams. The result included over 200 million worth of write-offs and impairments. However, the fact that they have a rising amount of their revenue coming from rental sources increases the quality of the company's earnings. Saru did not propose a cash or a stock dividend during 2009, and 293 million worth of the net profit was realised through the sale of 643,000 square metres of land. The company reported fourth quarter revenues of 438 million dirhams, driven by the land sale and also the reoccurring rental income from the Sas Al Nakil, Khalida Village and Al Uyun projects. Given the uncertainty overhanging these markets at the moment, ahead of the Dubai World restructuring proposal, we believe that the best place for dividends are defensive, strong cash flow generating stocks, and also companies that are paying a cash dividend yield over the next month. The highest cash dividend yield paying stocks include Air Arabia, RAK CC, First Gulf Bank, DFM, Bank of Sharjah, Emirates NBD, RAK White Cement, and also DIB. Dubai World's property and investment unit Limitless is reportedly renegotiating the rescheduling of payments to contractors on 3 of their large Dubai developments. The move comes ahead of Limitless due to repay 4.4 billion dirhams worth of syndicated loans during March, and is not surprising given that Limitless is likely being squeezed of its cash flow. Contractors may have to accept a 30% to 40% discount on outstanding payments, similar to agreements that Nikhil made with its contractors during 2009. DR Developments is also coming up with a repayment plan for contractors based around 100 million dirhams worth of payments due during February and March 2010. DR also owes around 1 billion dirhams worth of debt and has denied that it is in merger talks with UPP, which is a rumour that's been doing the rounds in these markets for over 12 months now. DR is expected to have around 16,000 apartments in its leasing portfolio and has an occupancy level of around 86%, which is very high for Dubai, expected to generate around 150 million dirhams in recurring revenue by 2012. Although similar to UPP, we believe that DR is a very risky investment at the moment and prefers safer plays in stocks that are of an industrial nature and generating regional earnings with high cash flow generation. The Dubai Shopping Festival is drawing to a close right now, and we've seen a number of people doing the rounds on the streets with flash new clothes in spite of the soft economy here. So obviously some people are surviving better than others. That's all for this week. Happy investing, Ilarika, and sayonara.